somebody's starting up a business and they don't have a lot of assets, they don't have a lot of income, but they're still just getting going because they're finally finding that sweet spot for selling the product, and it's still just like a really core small team, and they're getting ready to scale it. Do you guys have any general guidelines? Because I know that everybody's has their own customized plan that they need, but general guidelines on how a founder should hold. Welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes, and this is the podcast for Angel Investors Network and for people who are looking to learn about angel investing or raising capital or exiting businesses and scaling businesses. And in today's episode with Hart Williams, we talk about all of it, including for those folks who are successful business owners or entrepreneurs or want to be, what are the things you need to be thinking about long before you get to that liquidity event or that exit, so that you can really take some money off the table and you can continue to have the lifestyle you want? Or if you're a business owner, how do you maintain a lifestyle and still continue to run your business, still continue to control your business, even if you don't necessarily want to be the one running it all the time, and still have the ability to take advantage of the tax codes and build the wealth you want? So really great episode. And by all means, share this one if you love it, like it, subscribe. Thanks so much.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. I'm here today with Hart Williams. Hart, how are you doing today?
Doing great, Jeff. Thanks for having me.
Absolutely. Really happy to have you here. Pleasure. And looking forward to learning more about what you do in Cloud Capital and your advisory firm. So, but before we get into that, why don't you tell folks a little bit about who you are and how you got to where you are today?
Yeah. Obviously with Cloud, I work in the financial services space for a boutique investment manager and family office services firm. And I had a non-traditional, quote unquote, non-traditional path in getting here. I started my career in television broadcast sales, went from that to work for a few startups. One of the startups was a asset aggregator based in Colorado. And it was the first time I was in a job that was really kind of like more capital markets focused. And I loved it. Absolutely loved it. I went to business school, and during that process, I ended up somewhat accidentally starting a tech startup. We built a vacation rental management software solution. Raised some venture capital for it, ran it for 7 years and sold it. After that, I wanted to get back into something that was capital markets driven. So I did a lot of research and was really kind of interested in this space, the world of financial advisory and advice and investments. It's really interesting if you start peeling back the onion. So I started my career at the JP Morgan Private Bank, really to learn the space, and I applied some of my tech background to it and tried to kind of like hack and hustle my way through growth. And I was hired away by a New York-based family office called Bessemer Trust. And after 4 years there, ended up finding some partners that saw a similar pattern that I was seeing, and we built Cloud Capital to address the needs. So we've been operating for just coming up on 3 years, a little over 3 years if you factor in the planning work and research stage. And now we serve a few hundred clients throughout the U.S., have offices in Seattle, California, and Southern Florida.
Outstanding. Wonderful. Well, I'd love to learn more about what you were talking about when you said seeing some of the challenges or the opportunities, maybe is a better way of putting it, in the space of advising. Because I'd imagine you have certain licenses within your firm that allow you guys to do different things than your typical like life insurance salesperson does, right? I can only relate to that because I started my career doing that. In 2003, I got my life insurance license. So I was doing mortgages, and what I realized for myself was that I didn't really like just selling a basic policy or selling mutual funds to somebody, because it didn't really align with what I thought building wealth was all about. Right? I thought that there was so much more to it. And of course, in the last 2 decades, I've learned that there is a lot more to it. So I'd love to hear your take on, especially when you're working with some of these high net worth individuals, family offices and so on, they have different and unique needs compared to the vast majority of, let's just say, savers and folks looking for a retirement, right?
Yeah, I mean, there's really a couple of questions in that statement. So I guess the first one is like, what are the patterns that we saw that kind of informed us that we should start down this path? Yeah, so I'll start there. The things that we saw that were common were that, number one, if you look at this market of financial advisory services, it's a really, really fragmented space and there's no clear winners. So the most anyone really strives for, and I've been in meetings at big behemoth firms and they're striving to get to 1% market share, like just 1%. And it's a really, really relationship driven business. But like when you start looking at the services that they provide to clients, what they're attempting to do, in my perception, is meet as many new clients as they can. So do a really effective business development process. And then once they meet the new clients, get as many of them as they can into easily managed investment solutions, which don't necessarily satisfy the need of the high net worth or the future high net worth or the current high net worth or ultra high net worth space, right? Most of those clients, especially now, have unfettered access to things to invest in, whether it be through angel investing or through managers or through secondary platforms or through real estate interest or whatever it might be. And so our take was, we've really got to do more on the planning side and understanding like the wealth makeup currently of all of these people and factor in liquidity. Because like we see it all too frequently that, especially with startup founders and entrepreneurs, they find themselves in scenarios where they're working on a high growth business that may be generating a healthy amount of cash. And they're investing in a lot of things that are, although hopefully high growth, have illiquidity. Now, and no one's really walked through those investments with them and understood, does that illiquidity come with the appropriate premium? So, like, should we have put this money somewhere else, or should we have developed like a safety net because your business has cash flow fluctuation and you can go through a dry period? Should we have done things a little differently? So our whole approach was understand our clients better, to collect more data, use the data to make more decisions and create custom allocations for families and individuals based on what that data tells us. Now, to your second question about how do we structure this thing? How are we different? Well, we're, in the SEC's eyes, we're a registered investment advisory, which I believe that to be not necessarily the future because it's been around a long time, but I think that's going to be the most popular structure for wealth advisors and financial advisors who want optionality. Inside of a broker dealer, you just have more restraints. Right. Insurance salespeople have more restraints. Like, we don't sell insurance. We give clients like a service where we review their existing insurance policies and can make recommendations on whether or not they have enough coverage. But in the insurance world, it's really product driven, and not all those products fit all of those clients. And so you can end up with mismatches. It's, for us, a lot of the ways that we find success is really learning as much as we possibly can about clients, helping them understand the value of a transaction if they're in that stage, helping them understand the value of illiquidity premiums, and then creating portfolios around those kind of existing structures so that they serve as a completion fund.
I like that. And the thing you said about, when somebody is product driven is kind of reminds me of that analogy. When you're a hammer, everything looks like a nail, right? If you only have so many tools inside of your tool belt, you're just really trying to stick that, round hole or that round peg in any round hole you can find. And of course, not everybody has, the same needs. And that's one of the things I found that was very unique and different. Of course, here at Angel Investors Network, we are in that high risk, high return, high appreciation growth kind of world. And one of the things that we've noticed that you said as well is, the vast majority of people that have any capital to put into a startup venture of any kind, and we never recommend that they put more than a few points of their entire portfolio into something like this, is that one, you're talking a 5 to 10 year time frame, right? And during that 5 to 10 years, it's pretty much like, hey, just don't plan on getting your money back. And the vast majority of it, depending on how early that company is, don't plan on getting it back ever, right? So we've even looked at and said, okay, well, how could we sort of de-risk it, or at least create a way for people to start generating cash flow along the way? And this is what sort of opened my eyes to the broader financial industry. I used to work a little bit in the capital markets and really big in the insurance industry for a long time. And I know that there are ways to do this, right? There's hedges out there and there's things that people can do that allows them to generate a little bit more of that cash flow if they need it. Like you're saying, maybe not be so illiquid when you're putting your capital up, because you never know what the future holds and you may need that money back. And if you can't get it back, that's kind of a bummer of a place to be for a lot of people. And so I'd imagine you guys have found ways for, through different asset classes and strategies to help your clients sort of navigate those waters, right?
Yeah, absolutely. I mean, I don't want to misconstrue it. We're supporters of high risk, illiquid investments. Like, we like them. I own them. So does my partner. Founded a venture firm and ran it through multiple cycles. Like, he's got tons of portfolio companies. The risk, though, and the statistics on it aren't favorable to the investor. So, you say 5 to 10 years. Well, on paper, like, the average venture investment is actually 16 years. Because, like, when you're dealing with averages, you're counting all the ones that really go poorly, right? And yeah, they can create an immense amount of wealth. Like, they can be wildly successful, but the ones that are wildly successful, in my opinion, like, aren't even the top decile. They're probably the top, like, 1 or 2%. Like, when you look in averages, most illiquid investments return somewhere between 2 and 2.3x initial capital invested. And if you're waiting 10 years to get it, your money probably would have been better off somewhere else. So to your point, there's a lot of value in doing the work that you guys are doing in terms of, like, validating that the due diligence is done properly and getting more sets of eyes on it, and getting, different opinions on whether or not something would be successful, or that there are things that maybe weren't uncovered when it was just one investor dealing with one entrepreneur one-on-one. And then some of the work that we do is making sure that, when we have clients that have adequate liquidity, that what we try to do is immunize the lifestyle spending for that client for as prolonged of a period of time as we can. Because if we know that we can basically not touch the money that's going to affect lifestyle spending, then once we have satisfied that need, we can go so far above and beyond with risk, because it's not going to impact the money that they need to live, right? Most high net worth clients, like, have a pretty solid understanding of what it costs to operate their lives on an annual basis. And then once we kind of cover that base, let's shoot for the moon. Let's see what we can do. Let's figure out interesting strategies to get you there. And it might be something in privates, whether it's venture, private equity, hedge, an activist strategy. It's something in derivatives, or we're, placing a lot of options inside of a trade to try and get, a little bit more juice out of it. Or maybe it's something in real estate. So a lot of the work that we do is understanding kind of like where clients are, where they hope to get, the principal objectives that they need to fund over the next period of time, whether it's, funding college for kids, or paying for weddings, or buying the vacation home, or whatever it is, and then figuring out the back end of, okay, understanding all of these things in the future, like, how do we structure a portfolio so we can immunize as much of the spending and you can take the risk that you want to take.
Before continuing, please subscribe and share this video. to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
So you said something that was really interesting there, which is that a lot of these folks kind of know what it takes to sustain their existing lifestyle, right? And it's probably because of some of the people that I've worked with, but many of these folks have come into money relatively recently. And it wasn't like a 20, 30-year journey to get to this and they've stabilized their lifestyle. Sometimes we're talking about folks in their 20s, 30s, even 40s. And they might have kids, they might have just gotten married, they might just be getting ready to put kids into college and things like that. And so they're still relatively, we call them the new rich, right? They just either had an exit, they sold a business. Like we're actually working through a transition or an acquisition of a company right now run by a 27-year-old. And he's about to, hit roughly a 8-figure net worth, almost, just like that, right? Because of the acquisition. And it's really interesting because he has a very, very different mindset and outlook on life and a lifestyle than say somebody in their 50s who their kids and their families have stabilized and they've had the money for a little while now, or they've, a wealthy executive or a doctor or something like that. And so how much of what you guys do goes into helping them understand, here's how you manage the existing, what you need to cover your existing lifestyle, and then providing this, hey, how much do you want to shoot for the moon outside of that?
Yeah, we do a ton of that. And like being totally candid with you, like the spending discussion with clients, like that's the hardest one, right? Because like they'll acknowledge certain amounts of it and they won't acknowledge other amounts of it. From a
secret cigar collection that the husband keeps that he doesn't want the wife to know that he has $100,000 worth of cigars somewhere, right?
Right. Or like, oh yeah, it costs $200,000 to operate our life for the year. And then they're like, oh yeah, I do, buy a new car every year, or I do this, or I do
right.
do that. And like, it kind of comes out over time. What we do is we look at all of the expenses and we categorize them into two principal buckets, right? Either the expenses are essential, which is like food, shelter, clothing, or they're non-essential, and like, which is vacations, collections, Amazon, eating out, that kind of stuff. And what we want to do is find ways to immunize the essential side of that, which is, imagine a scenario where, say you had a bucket of money and it was all on the market, right? And you had your annual spending and it was broken up in half of essential spending and non-essential spending. What we try to do is give clients confidence that in an adverse market scenario, whether it be a 2008, scenario or a 2020 scenario where there's like the black swan event of COVID, if you were living on the income of that portfolio exclusively to cover both sides of the bucket, you could theoretically restrict your non-essential spending down for a period of time, and with full confidence, very low risk, you could cover your essential spending. And then as things improve, you would see overperformance, and that overperformance could be allocated back to the non-essential spending. So the first thing that we do with clients is we understand, okay, what's essential, what's non-essential. And then when we look at objectives, whether they're, near-term, moderate term, or long-term objectives, we bucket them out in a similar process. So we determine which objectives are also essential, what is considered important. So it's something that's, hey, that really needs to get funded, but we have time to do it. And then what are the discretionary things in terms of objectives? So an example of that would be essential could be, hey, I want to make sure that I've got a protective reserve where I could survive a full market cycle of 7 years and not touch the principal of capital. An important might be, hey, I got to pay for a wedding, or I've got to make all these capital calls, or I've got to continue to fund my business for a period of time. And discretionary might be like, hey, if things go well, I'm going to buy a vacation home, or I would like to travel more, or I would like, to do a really large remodel, but it's all predicated on the growth of the investment portfolio or the growth of the overall net worth. So by breaking it down into this kind of like simple structure, we can really see clearly like where the Venn diagrams overlap and how much of the investment strategy is really dedicated towards covering the essential needs versus covering discretionary needs.
I like that. That makes sense. And I think a lot of people, theoretically, this is very logical and like, oh yeah, we could figure that stuff out and put it all in paper. And then they even look in their own personal financial statements, say, okay, let's look this stuff out and try to start figuring out. But like you alluded to, I think a lot of people, they don't even look at it and know exactly where the spending is going and what is essential versus what's non-essential, right? So I think those are really important pieces for people to understand. That's why you like to have an outside advisor and somebody kind of looking into this. But another thing that I was thinking about is, as you're going through this, is that at what point in somebody's career, and we'll use entrepreneurs, for example, or business owner, that's the vast majority of our market. At what point do you say, hey, it's time for you to sit down with a professional like us, like Cloud Capital, and start really looking at this, right? And I'll give you a really specific kind of target, which is the folks that are about to go through an exit of some kind of liquidity event, whether they're, finally getting to a Series A or Series B, and they can start taking a little bit of money off the table in this company they built, or, they've been running their small business for 20 plus years and they're about to maybe sell a portion of it or sell all of it or something like that. Like, at what point do you guys say it's time to engage? Is it post getting the money in, or is it, I think I know the answer to this.
No, yeah. Money's like a really interesting topic for people because it gets really emotional. And the emotions of it, I think, often stem from the source of the capital. Like when you deal with somebody who's nearing retirement and they worked on the same business for 20, 30 years, right? And this is the ultimate event that is happening that is going to make their transaction happen and their retirement happen. Like there's a lot of emotions involved. When it's somebody who's 20 or 30 and they found success early in their career, like the assumption that they make is that they're going to be able to do it again and again and again and again. Our preference is that, sooner is always better, because what we want to do is condition people to look at the information that we look at so that they can start to look at that information on their own. And then as they approach the idea of exit, maybe it's 18 to 24 months before an exit, that's really when they should start to engage and develop a relationship. There's a lot of things that happen when you sell a company that you can get benefit from by working with someone who's done it before. And like for Cloud, like we have a transactional tax attorney on staff that evaluates the water flow of large financial transactions and where taxability can come in. And once the transaction happens, even a few months before the transaction happens and a letter of intent is signed, it really handcuffs the ability to do creative things to mitigate the tax implication of a large sale. So you want to get
give me some ideas of what that actually means, because I'm very curious about that, because we think about this all the time when we're talking about 7-8 figures that are going to be transacted with people. And I'm not a tax professional. I don't even claim to be one on TV, right? But I know that there are massive capital gains issues that can happen if somebody, just even based on timing of a sale, right?
Right, exactly right. So obviously there's a lot of different taxes that can play in, and they can play in depending also on where you live, right? So like recently in Washington State, we enacted a state capital gains tax, which taxes long-term gains above a certain threshold. An example of ways which people have gotten around that, and they're, maybe they haven't or have, depending on the scenario, but like we had a client who was splitting time between here and another state, and his kids were actually enrolled in school in the other state, and he was still a resident of Washington because his business was here, and he was spending 185 days here and 180 days there. And over the past year, he was spending more and more time because once they sold the business, they were going to relocate and do that, right? So like in his case, it made a lot of sense to relocate early and then sell the business as a resident of the other location. Other structures can be, all inside of the trust and estate planning space. So say you have a large exit, a portion of that's going to cover future expenses for your children. right? You could basically gift shares out of your company to a trust for the benefit of your kids. It could be irrevocable and in a different state. And it could be for their benefit based on the standards that you set in the future. But by moving those out of your estate prior to sale, those would not be taxed with the same tax as if it was all income to you. Other strategies come into gifting also. So post-transaction, people can put money into donor-advised funds. They intend to be philanthropic. And they can put it all into a fund the year that they transact and then spend those assets from a philanthropy perspective over a long time horizon. So they get the benefit in the year one when they have the huge tax hit, and then they get the flexibility to use the money for that intent in the future.
Are there time constraints that people need to think about? Because I know the IRS is pretty smart, as much as we don't like them, and who knows what's going to happen with the new administration coming in, right? But, I have seen situations where people have last minute tried to make changes on paper that would help them and prevent a massive tax issue, only to find out later that doing so violated, certain statutes of timing limitation, right? Like you think about 1031 exchange, so there's very clear guidelines on when a 1031 exchange will work and when it won't, and what you have to do during that timeline. So are there things like that when it comes to selling a business that people need to be aware of?
Yeah, absolutely. I mean, the major one that we look for is Section 1202 of the tax code. It's the qualified small business stock exemption. There are certain time limitations inside of that exemption, right? You have to be operating as a C Corp for more than 5 years. It's the total assets of the business have to be less than $50 million. But that allows you to take either $10 million or 10 times your initial cost basis out tax-free. The thing that I will say
that's only good for certain types of businesses, right?
Certain types of businesses. So consultancies are a no. Healthcare businesses are a no. There are a few others. The bigger thing that I would say that I think is more valuable to the average listener is to understand that doing trust and estate planning takes months, right? It just takes months. You can't do anything quickly because everything's got to go through the courts. You're working on the time of on attorneys that are very, very busy. And so it's really important to get way ahead of that stuff. And that is the foundational work of doing pre-transaction planning. So you don't want to run in being like, hey, we close on Tuesday. What can we do to mitigate the expense here? It's just the options are going to be basically zero, or post-transaction planning, which are much, much lighter than pre. So getting ahead of it early, making sure you have a solid, it's good practice for any entrepreneur to have a solid plan if something were to happen to them. So as the business is growing, as you're reaching a Series A milestone or reaching certain liquidity levels, make sure you have a plan. Have a plan with your partners as well. So have a plan where if something were to happen to you or happen to one of your partners, you don't end up working with the crazy uncle, the crazy cousin, whatever it is, whoever the beneficiary is. So have a plan early, adjust it often, and then once you start kind of seeing a potential transaction on the horizon, act then, right? Hey, this could happen in the next couple of years. I want to get ahead of it. It's the best way to mitigate any sort of overpayment.
I like that. That's valuable, very valuable advice. Along those same lines, somebody's starting up a business and they don't have a lot of assets. They don't have a lot of income. This is the space we work in a lot. These companies are just getting going. Maybe they're making $10,000 a month. Yes, a couple of them making a few million a year already, but they're still just getting going because they're finally finding that sweet spot for selling the product. And it's still just a really core small team, and they're getting ready to scale. They want to raise, seed capital or Series A capital and go take that hockey stick. Do you guys have any general guidelines? Because I know that everybody's, has their own customized plan that they need, but general guidelines on how a founder should hold the shares of their company. Because we have seen people that have come to us as sole proprietors, and we will tell them flat out, we can't help them until they fix that, right? As a very basic, but again, I'm not a tax guy. So I don't give them any other advice other than go find somebody who can help you out with all that.
Yeah. I mean, there are a million different scenarios where people need specialized help. Right. The thing that I would say is don't skimp on kind of like the basic foundational stuff. Don't just go out and operate without some sort of structure put in place, and make sure you've got a reliably good attorney who can help you with, okay, what type of structure is important? Like, they will ask you the questions like, do you intend to raise capital? Like, where is the money coming from? Like, how soon is that going to happen? Like, should we in the formation docs today structure this in such a way that you could sell shares of it to outside venture capitalists or others? Or you could, sell debt or sell equity or do whatever you need to do. The other piece that's really important is start the bookkeeping process early. So like, make sure even before you start, you've got a bookkeeper lined up, you know how you're going to file your returns, because it gets really messy and it becomes this massive time suck if you're like at the end of your first year and this thing's starting to run away, which is great. It's like a high class problem, but now you got to go back and like clean up the books, right? So like, get started early on that side. Make sure you've got that structure in place, because most solid bookkeepers and solid CPAs that are going to file returns for you can expand like up to $10 million in EBITDA, right? And so like, if you set it up properly and you're really doing the necessary steps and building a solid foundation, it will grow with you. It's much easier to have it grow with you than it is to like go back and try to build it while you're still flying the plane. But I mean, generally speaking, I will say this, like generally speaking, there's some things that you want to do as an entrepreneur. So obviously have the right entity structure. If it applies, file an 83B with the IRS. So sole proprietorship, like generally isn't in your favor. Like to raise capital, it's got to be either a corporation where it's an LLC if you're selling, LLC units, a C Corp if you're just selling shares. Sometimes an S Corp or an S Corp election on an LLC could be your friend if you're thinking about that sole proprietor land and you don't see a future where you're raising a lot of capital. So there's a lot of different structures, but having a good attorney that can help you set that up is helpful.
Now, we are running low on time, but I have one important question I want to ask of you that I think, we've talked about a lot of the entrepreneurs and the business owners, but we're finding a lot more now, the baby boomer generation is retiring. And from all the stats I've seen, they've been the biggest generation of business owners in a very long time. And as a result, we're talking some estimates in the neighborhood of $10 trillion worth of business sales that are occurring over the next decade or so, right? And these folks are transitioning, but let's face it, this is not the generation of sell, retire, go off and have the retirement home and not do anything ever again. And we're actually finding a lot of these people still want to be involved in some kind of venture in some capacity, but it's not as the operator, right? They might want to invest. They might want to come onto the shareholder calls. They might even go to the annual events or something like that that some of these companies might be putting on, and they still want to be involved, but they don't know anything about venture investing. And so how do you guys talk to clients about, becoming either an angel investor or investing in GP stakes or venture funds or things like that? And what kind of, I guess, percent of a portfolio would you suggest they look at, or if it's even a good fit for them? I mean, I know there's a lot to unpack there, but how do you guys have that conversation?
Yeah. So I'm going to kind of take this in chunks. So the first thing is like the piece on baby boomers retiring. The thing that I would say is like baby boomers, it's hard for them, based on a gross generalization and what I have seen in my career, to relinquish control before they sell the business. And I'm not suggesting that they do, but the thing that they can do that's very beneficial is they can start succession planning early. And succession planning doesn't necessarily mean you're doing anything, but we've seen it in multiple occasions where people wait to do the succession planning, wait to have the conversation, and then they have some health event or something where the transaction happens very quickly. And it limits their ability to have all the conversations to get the successors up to speed. So it limits their optionality. So if you're a business operator and you're thinking, maybe 5-10 years out, like start succession planning now. Because like if you don't talk to your, high performing daughter who you think is the future of your business, if you don't talk to them now, they're thinking you don't want to do it. And they might be going off on their own career, and it might be a lifestyle change for them to come back home and run this business and do that kind of stuff. Like, get rolling on that early. Or if it's a sale to partners or sale to employees or whatever, it can be a wonderful retention piece that you're thinking about, but if you don't socialize it with them, they don't know about it. So that's like a really important piece for the baby boomers who are current business owners. On the second piece of like, who qualifies for venture, how much is the right component or the right amount? Like, illiquid assets serve a couple of different purposes, right? A portion of it could be hopeful potential future growth. A portion of it could be, I want to see this change in the community around me. And a portion of it can be like, I want to do something different than just the typical, buy a publicly traded security and keep rolling. So what we do with clients is we look at the entire picture so we can look at everything that's there and understand what liquidity levels exist across the current structure. And then based on that liquidity level, we can make a recommendation for what would be the appropriate percentage. Like, really, with some exceptions, like, you don't want a client who's more than 12 to 15% illiquid. And there's clients that are probably listening to this, the clients of yours or members of your network, who are like 80% illiquid. And that gets into a dangerous space because you could have an event where you have a high cash flow need, and although you're really wealthy on paper, if you can't satisfy the high cash flow need, you have to sell something. If you have to sell something that's illiquid, the only way to do it is to sell it at a material discount to its current value. So like, that's a big risk, which is so what we do with clients is we understand where the liquidity levels are, and then we try to fill the gap to get them to a certain level by allocating to appropriate deals. But before we ever allocate, a huge component is understanding the strategy of what we're doing. Like, the spray and pray method of, I see all these deals and I'm going to do the ones that I like, or I have great deal flow from my network at the country club or my network of friends that are entrepreneurs, and I'm going to invest in businesses that are there. That's generally not as successful as having a very cohesive strategy and investing in that strategy. So being like very thoughtful about the growth that you want to see or the businesses that you think are going to grow over the long time horizon. And it could be something like, I'm investing in companies who have novel technology in the robotics space, right? That's a very different deal than saying, I'm investing in high growth companies that are technology driven, right? By starting to like shrink down the area that you're really focused in, it helps you get into kind of better investments into that space and increases the amount of knowledge. So when you look at 2 or 3 different deals, you can very clearly see the ones that are going to be more successful. The other thing that I would strongly consider is that it's not like, think bigger than just venture, right? Like, venture is like one niche sector inside of the greater alternatives world. Like, there might be hedge funds that do the same thing that you're trying to do, but they're approaching the market from a different perspective. There might be private equity funds that are approaching the market from a different perspective. There might be debt funds and private credit funds that are approaching the market from a different perspective. And they have the same illiquidity premium. But the risk profile is dramatically different. And so mixing some of those in could be very, very helpful. Generally, just like if someone came in and they were 100% liquid and they own their home and they had this massive portfolio, we would not feel that it was suitable to go above 12 or 15% in total, like, illiquidity, right? Because like, that illiquidity translates to this risk, and we have to make sure the premium is there. The other thing that I would do is think really critically about the time frame. So if I were to invest in, the Jeff Barnes Venture Fund today, most likely it's going to have a series of capital calls to get my initial commitment into the fund over a period of time. If you make 4 or 5 commits today, that means those capital calls now have 5 layers, right? So you might get called for $20,000 5 times across a year. Like, we think that it's much more powerful to build a ladder strategy with a lot of these efforts where you're saying, we're going to review 8 to 10 deals this year. Of the 8 to 10, I'm going to pick 2, but I'm going to pick 2 every year for 5 years. And then I'm going to take a breather and let those really mature. And then as I get liquidity out of those deals, I'm going to then reallocate that liquidity into 3 deals a year. So you're building this ladder where hopefully 20 years from now, you've got liquidity events happening every year from your ability to develop a ladder over time.
I like that. And that's really sound. And you guys have obviously thought about this and thought through this process with folks. So I really love hearing that. Hart, I want to thank you so much. We're a little bit over time here, but this has been an incredible interview. Really great to hear your wisdom, your knowledge, and obviously you've had a lot of experience in working with clients through a lot of these different areas. So thank you so much for sharing this wisdom with us. Why don't you tell folks a little bit more about how they can find you online and connect with your company?
Yeah, so we obviously have a website, right? cloudcapitaladvisors.com or cloudcapital.us. We'll get to our website. You can learn more about our services there. If they're interesting to you, you can inquire through the website. But I'm also, if you've got specific questions, you can email me directly. Hart, Hart at cloudcapital.us. I'm also on LinkedIn. And if you're in the Seattle area, I'm downtown. So we always welcome the opportunity to look at client scenarios. We do a lot of modeling in our traditional kind of onboarding process before a client ever commits to joining the firm or paying a service fee or doing whatever. And if you would just like to see what different scenarios look like or how we would look at your scenario, we're always happy to do that modeling for you so you can get a different set of eyes on it and different perspective.
Awesome. Thank you so much, Hart. I really appreciate it. And thank you guys for listening and watching this. As always, it's the Angels, Exits, and Acquisitions podcast from Angel Investors Network. And you've been listening to Hart Williams of Cloud Capital Advisors. Hart, thank you so much for being here today.
Thanks, Jeff. Great to meet you.